Good morning, everybody. Kirk Spano, stocks of the week and retirement income options. We will be talking mainly about stocks and earnings today and the earnings environment and the opportunity that I see to buy what could be a pretty big dip going into the summer. Now, I wrote an article earlier this week, actually over the weekend, and put it out, and I'm going to try to write another one tonight and release it in the middle of the week. What we see right now is that it is becoming apparent that interest rates will be higher for longer. The traders' narrative had been that interest rates would come down by the end of the year. And I think that Chairman Powell made it abundantly clear that that is very unlikely. Now, Powell did use the term disinflation 13 times in his press conference. So he is aware that inflation is moderating. Why would he say that he believes interest rates need to stay higher for longer? I think there's really a couple of reasons. The main set of reasons is that there's a lot of risk overseas. And the risk overseas is that Russia, OPEC, or China, or some combination of those three will drive energy prices up. This is a chart from the Bureau of Labor Statistics from last September, and it shows that the primary cause of inflation back when it was hotter was energy. And of course, that was a theme that we covered for well over a year, that inflation was being caused by higher energy prices and by choked off supply chains because China was engaged in COVID zero policy. Now COVID zero is over, and we should probably expect the same type of revenge spending among the Chinese. And there's 4 times, 5 times more of them than there are us, than there are Americans. Granted, not as wealthy, but still many more people. That should drive demand for goods, services, and energy higher. In addition, we're almost done with winter. And that means that Russia is likely to re-engage the attack of Ukraine. And OPEC, of course, is always at risk. And now we see that Benjamin Netanyahu is back in power in Israel and has been engaged in drone attacks on Iran proper. That probably doesn't lead to anything good. So we have the potential for Russia to stir up the works, although their impact has been normalized mainly due to a warmer winter and inventories being used. And in fact, inventories for gas anyway went up a little bit in Europe, but it's not nearly enough to handle a cold winter. So there would have to be some luck involved a year from now to avoid a natural gas pinch, especially if there are any disruptions in the Middle East, and if indeed aggregate demand increases because of COVID zero policy being ended in China, and a lot of Chinese decided, we're going to get out of the house, we're going to do things, driving demand up. So there's 3 particular items that really should not be considered black swans because we can see them, that could drive the price of energy up. And I believe that is why the Federal Reserve is trying to tell everybody, hey, interest rates are going to stay higher for longer, which means the quantitative tightening is going to continue for a while. So I would just remind you that trader narratives are typically wrong. They are designed to get you to run in one direction so they can complete their trades, trying to get you to sell when they want to buy and trying to get you to buy when they want to sell. Be very careful with that. While the traders will fight the Fed as long as they can, as soon as the tape turns and the trend is no longer their friend, they will reverse their trades, and they won't tell you about it ahead of time. If you know who Martin Zweig is, his number one rule was, you can try to fight the Fed, but don't fight the tape. So while it was okay if you're a trader to chase stock prices up in January, probably not a good idea to stay long if prices reverse like they have on Friday and today. So I would expect the traders to keep reversing course. First traders have already moved, and eventually the rest of them will too. And then we'll see what happens to overbought and oversold conditions on different time frames. The daily will go oversold first and then probably bounce. But if there isn't good news, it'll head down again and that will pull the weekly time frames down even more. Remember, shorter time frames move first, daily, then weekly, then monthly. And remember, the trader's narrative about the Fed easing sooner than later is probably wrong. Like I've been telling you for a year and a half, it would be telling you early on that the Fed was reloading its bazooka, waiting to see what would happen with the baby boomers retiring. I don't see that crisis for several more years, but there was a headline in MarketWatch that it was basically starting already. We'll see. Another line of thought that I put up 2 years ago was that the bailouts for COVID were so huge, exceeding the losses in the economy, precisely because they wanted that money in the economy to cushion against the baby boomer retirement crisis, a financial crisis of the baby boomers, like 70% of them, having almost no money for retirement. That's 2/3. So for every baby boomer who is going to be able to retire, 2/3 of them are going to have to live very frugally, probably find part-time jobs as long as they can handle it to make ends meet. Low unemployment, though, gives the Fed cover with interest rates and quantitative tightening to keep the dollar strong. Remember, we always talk about the Fed's real job is to manipulate the dollar, and you'd want a strong dollar if you're afraid that China, OPEC, and Russia might drive inflation up again over the summer. And what if we have a hot summer? Granted, Europe doesn't have the air conditioning that the United States has, but hotter means more air conditioning wherever you are. It'll be a lot more in America if it's hot, but it'll still be more in Europe if it's hot there. We know that the planet is heating up, and whether it's us or the sun or the aliens with a death ray, it's not going to change anytime soon. Because if it is the sun, those cycles last 11 years. The fact that it's been cycle over cycle over cycle now for 5 decades of the planet getting warmer probably tells you there's a trend in place. And just like the stock market, you probably don't want to fight the trend. So I would encourage you to read this article if you haven't already, because if interest rates stay higher and QT continues into next year before coming down, and I do think it'll come down next year, maybe even after Labor Day, which is what I've been saying for quite a while, it's going to have a particular impact that is going to be unfamiliar to those who really don't understand economics, like Austrian school economists. The recession that's coming, if it comes, won't be like other recessions, unless we get a financial crisis and then all bets are off. But we are well into the slow growth forever global economy. We've seen GDP growth lower since 2007 than it was in the prior period. And that growth in the prior period from the 80s to 2007 was lower than it was in the post-World War II era. This is all because of aging demographics. There's more and more people at older and older ages. The planet is aging, very simply. So that means fewer people working as a proportion and more people requiring assistance from the government, which means the working people are paying for that. Luckily, we're pretty smart, and technology that we've created and continue to create, the technology that the technology creates, are right at the point of reducing the amount of work that we have to do per week. I'm not sure when all these curves smooth out. I really don't think until about half of the baby boomers have passed away. So you're looking middle of the century, 30 years out. But between now and then, we have to deal with the reality that there is an imbalance between labor supply and labor demand. And there's certain things that robots can't do, like kindly take care of somebody who's older that needs the help. Off air, I discussed how broken our system is as I try to help somebody. So we're going to need more labor, not just now to cover the jobs that are outstanding, but there are going to be a generation's worth of jobs in healthcare that are currently unfilled. That's why immigration has been a big topic lately. We need to let about 10 million people into the workforce that are not even in this country right now, which means that we probably need about 30 to 40 million immigrants over the next decade or so. Because of course, they don't just come over one person to work, they bring their family. Eventually, that'll be great for housing stocks. Again, way back 2012, I wrote this in a MarketWatch article. I agreed with it. So this labor shortage was not unpredictable. I talked about it a decade ago that it was coming. And it was here already when COVID hit, when COVID changed it. For a hot minute, there were more than enough people to work, but we didn't need them. And a lot of baby boomers retired. And a lot of those millennial men, that million millennial men who have never worked full-time in their life, the ones that I make fun of, one of which is in my extended family, they even didn't go back to work. So we had millions of baby boomers retire earlier than they had expected. And a lot of them are coming back part-time. No doubt about that. Statistics show that. But they're never going to work full-time again. They're never going to reopen their businesses. And proof of that is the real estate market, which is just slowly deteriorating on the commercial side, particularly office buildings because of remote work, but also storefronts that nobody's reopening a business in. I've seen them all over the country, 7 or 8 cities that I've been in the last couple of years since the reopening. So in that backdrop of tight labor markets and a Fed that's afraid of inflation given to us from overseas actors, financial conditions are going to remain a little tighter. I talked about financial conditions indexes last week, and you can see that things have started to stop getting tighter. You can see the bend in the curve flattening out. This is exactly what Goldman Sachs said regarding their financial conditions index. This one is from the Chicago Fed, and then Goldman Sachs has a tweaked version of their own, but it looks like financial conditions are not going to get easier for a long time. So that trader's narrative is wrong, unless there's an event that makes them luckily right. But between now and then, they're just going to follow the tape and tell you what you need to hear to do the wrong thing. So unless you are a day-to-day trader or week-to-week maybe, you better be careful, and you should not play in that trading game unless you truly understand what's going on. And that is, most of it's lies, misconceptions, and bullshit. So let's cover this, the earnings from last week. There weren't many on our list, but there were a lot. So let's take a look. 70% of the companies that are reporting already, or that have reported already, and it's a little over half right now, have beaten their estimates, but just barely. Low single-digit percentages on aggregate. Normally, to see support for the stock market, that needs to be low double digits, because the bar on earnings is always set lower so that management can make sure they get over it so nobody gets mad at them. According to Morningstar, earnings are only up 0.7% this year. Excluding energy, they're down. Per FactSet on Friday, of the S&P 500 companies, and remember where I told you the risk was large caps, 37 S&P 500 companies have issued negative EPS guidance, and 6 have issued positive. 6-to-1 negative to positive on earnings per share guidance. That's probably going to leave a mark. In the fourth quarter, again, excluding energy, things would have been much worse. But even in the fourth quarter, we were down fractionally on earnings. So here we are, back-to-back quarters, excluding energy, which is inflationary, earnings have been negative. Over the next quarter or two, with higher rates for longer, I don't see good things. I think that the earnings that we got on our investments in January are very tenuous. I think between now and the third quarter earnings, you're going to see a lot of volatility and probably some losses. I would encourage you to right-size positions that you made some of your money back on. So if you scaled in 2 or 3 times, you're in a position to sell one of those lots. Hopefully something you're even on, or close to even, or even up a little bit. A number of our stocks went up last week in the middle of the week. Unity, a number of others. So if you have any right sizing to do, I'd do it quick before there's follow through on any downside. I wouldn't piss around looking for 1% in either direction. Raise some cash, trim some things that you've been intending to trim. Do it fast. S&P 500 stocks. Google reported at $1.05 versus $1.18. I don't think that portends anything horrible for the company. There's more pressure on them to be less monopolistic. But as we've seen, monopolies in technology don't last very long. ChatGPT is being used by Microsoft now. They're going to get part of the search market. Amazon is getting part of the search market. At some point, Google will unleash one of their AIs, upgrade their search, and their argument will be, hey, if people want to go to another site, so be it. And they'll just raise prices a little bit or not, but there won't be any sanction. Where they might get some sanctions is in their app store. And I think what they will do to solve the problem of them and Apple dominating apps is they will just allow independent app stores on their platform. They might lose a little bit of business. However, they won't lose any margin. And ultimately, if they lower prices, that makes it difficult for others to develop. So they still have a huge impact on search and ads. It'll just be different, be slightly more competitive, but those players have startup costs and they are unlikely to change things quickly. And Google has had in their back pocket for a long time what I have told you they had, or in their front pouch, whatever you want to think of when you visualize this. It's the baby Googles. They have over a dozen companies that would be big in the billions of dollars, some of them SP 500 size, anytime they want to birth those companies. Right now, mergers and acquisitions activity is down. It's in a trough. Google doesn't have to wait for financial conditions to get looser because they're super cash rich. I would expect Alphabet to engage in M&A maybe by this year. There are companies that we've talked about, CenturyLink and others, that would make a lot of sense for them to merge one of their divisions into those companies and figure out how the finances work. Go down to Apple and Ford. Apple missed by 6 cents, mainly on China, production and demand. Per stock rover, their price to earnings ratio is over 22 right now, but more importantly, because their growth rate's only a little over 8%, they'll probably jump up to 10. Their PEG ratio is well over 2. It's close to 3 at the moment, but as growth goes up a couple points, it's a little lower. An ideal PEG ratio for a growth company is around 1. For a dividend payer, it can approach 2. Apple's kind of in the middle. It's a high growth, low dividend paying stock, or think of it conversely, it's a slow growth company. It pays a small dividend. Depending on how the market values Apple in a given quarter or two, if we can get Apple close to 100, it basically means that all their price to earnings ratios are normalizing for a dividend stock. And remember, they buy back a lot of shares. So even though their yield is low on dividend, their shareholder yield is pretty high. We can see that over at Stock Rover. Go up to the dividends tab. I have mine set up to include shareholder yield. So the shareholder yield is 4.3%. Most of it from dividends. Most of it from buybacks versus dividend. But if Apple truly becomes a dividend play, and I think Warren Buffett is banking on it, this yield is going to go up. So if it gets to about 1% on share price decrease, I think you need to buy it because I think you're going to see much higher dividend increases in the future. I don't think they're going to continue hoarding cash. It's a mature company. It's moving heavily into services. Almost everything is built out for that. Apple Home, Apple Car, all that stuff is coming in bigger and bigger pieces and market shares. Google also is going to get into all those things even more than they are already. I think the one that's going to suffer is going to be Alexa, where Alexa is going to have to tie into Google much tighter, or Apple. They were first to market, but I think as the homes are built, they'll more be on the back of Apple and Google, and that has been the trend. So I like Apple on a correction when everybody hates it for 90 seconds. We'll have to be nimble, and we'll probably have to buy in rapid succession. I'm looking for that in Q2 or Q3. Ford had learning curve issues with building the Mustang Mach-E, had to do recalls and fix some design issues. They had too many wires in the car. So they're upgrading the brakes. They're reducing some of the components. They're making the car lighter by, I guess, 30 pounds just by removing stuff they didn't need or they had overdone. Wires, in particular, wire harnesses. I think in the next 2 or 3 quarters, same thing for Ford. They're already the number 2 EV maker in America. They have a massive following, way bigger than Tesla. By 2026, it's the year that I keep coming back to on this. The kink in the curve will be getting hit on EVs. The next kink, really. EVs are already almost 10% of cars sold in America, and that's with supply problems. By 2026, you're going to see a massive, fast move towards new car sales being around 50%. 27, maybe by 27, starting in 26, getting there in 27, something like that. And by 2030, Ford will have blown by their estimate of 40% of their cars being EVs, blown by it. And they'll probably only sell one ICE vehicle. They'll have a muscle car of some sort, probably a Mustang. Although they're designing a muscle car electric Mustang right now that doesn't have the hatchback, it just looks like a Mustang. And there will be some neat YouTube videos when those come out, racing the EV Mustang against the gasoline Mustang. The EV is going to kick the gasoline's ass. Torque, right? It's all torque. So if we can get Ford down around 11, I think we'll get that chance. And if you don't have it yet, you need to buy Ford, because the real upside in Ford, as I've talked about several times, is the freeing up of the real estate to do other things with Ford's fourth industrial revolution technology. And they'll probably sell a couple pieces too. But Ford is going to become a conglomerate based on their technology. I always point to, remember the ventilators. It took them 3 weeks to flip a factory from cars to ventilators. They're going to build a lot of things in the future. I think they're going to be like Lockheed Martin, but with cars instead of airplanes. Not a lot in the mid-cap and small-cap space that reported. A lot of it is this week, in the next several weeks. A lot of the small caps are in March. So we have 90 companies reporting this week. What does it say? 93 companies reporting this week, mostly large caps. And we'll see what those are. But excluding the energy companies, many of which have reported already, I don't expect it to be very strong. I expect the executives are going to lower the bar because they see what's coming. That's a Federal Reserve that doesn't back off until it's positive. Russia, OPEC, and China aren't going to push the price of energy up. Fidelity has been saying all the same things I've been saying recently. Took them a year to catch up. Only a mild economic recession if we get one. China is inflationary. Again, why the Fed is fighting it. And the Fed will still slow its tightening cycle, but they're not going to turn it off in case they got to turn it on higher. So they need something coming out of the faucet so people don't get conditioned to think that it's gone. So while inflation is coming down, and Tom Lee talks about this a lot, we're not certain it's going to stay down because energy is so volatile. Tom Lee focused on disinflation. He has not talked about the international risks for inflation, even without acknowledging that, and he hasn't. He's saying, look, the jobs report was really strong, so you have to be wary. But it also means the U.S. is not in a recession, which is good. Well, another way of saying that is the Fed has a lot of cover because unemployment hasn't gone up. Tom Lee is saying that the second half of the year should be pretty strong. I've said after Labor Day, so we'll call it a horse apiece. When the year-over-year comps come in the fourth quarter and the first quarter of next year, they'll probably be good. The stock market will probably start to understand that sometime in the third quarter. Could be the August earnings, could be after that. I really do think the market bottoms in summer, but it could be a little later towards Labor Day. Somewhere in that range, hard to know, to the exact month. But the 2 middle quarters of the year, I think we get our bottom. Forest for the Trees points out that consumers are starting to tighten up. Well, of course, everything in the press is scary. But you know what happens? Come summer, people want to get out and spend, and do things, move around. What do we know about the 4 quarters of the year? Which one is almost always the slowest quarter of the year? We've talked about this 100 times. First quarter, exactly. First quarter is almost always when things slow down. And then it comes roaring out in the spring, and especially in the summer, June, July in particular. So we'll see. He's a pragmatic guy, but he does have that Austrian tilt, and he mistakenly worries about American debt. Folks, if you think about American debt the way you would a mortgage, you wouldn't be scared. The net asset value of American assets minus debts, and not just government debts, but all debts, private, corporate, everything. The net asset value of the United States of America is around $200 trillion. And that's just what we count. Doesn't really include everything that's overseas. So the net asset value of the country is about 200 trillion. The asset value of the country is about 300 trillion. We have about 100 trillion in debt between government and private entities, whatnot. So if your $1 million house had 70% equity, would you be worried about going bankrupt or getting foreclosed on that house? Probably wouldn't be. It would be no sweat for the United States of America to double its debt and still have it not matter too much. Because if that happened here, it happened everywhere. The United States is fabulously wealthy. And the numbers I cited, you can look them up. They're right there. Take a look at the earnings page on in the Financial Times. It's free. Some of the articles might not come through for you, but it's a great summary. MarketWatch, which a lot of you have, theirs isn't laid out as nice as far as I'm concerned, but it's here. Morningstar has pretty good coverage, and this is free. FactSet puts this report out for free. It's linked in the article every week, I think. Just go here. I'm going to close with the IMF just because I've been reminding everybody. And I have a whole new service available over at Fundamental Trends, which focuses on the emerging markets. Read this report from last week about the global economy, emerging markets, and China. It's an important piece. It's one of the better ones I found right here. This is growth, emerging markets, developed markets. 3/4 of global growth over the next decade is going to be emerging markets. India is going to be one of the biggest growers, but also a lot of Asia and Africa, Middle East, South America, Central America. I think we're really going to help Central America at some point. So while I'm not telling you to put 3/4 of your investments into emerging markets, you need to be aware of it and at least make sure that your American investments have business in the emerging markets. It's why I like American Tower, but not so much Crown Castle. All right. Got a lot of stuff out of Stock Rover this week. If you really are looking to screen or monitor the strength of your portfolio, you've seen the links that I have on Stock Rover. I tell you what, if you're going to do this type of work, you really want to keep track of the trends for your stocks. This portfolio system is worth whatever it is, $300 a year. All right, I'm going to let you go. I'm going to get this posted before I leave for Vegas. I'm going out of town for my birthday to visit my mommy for my birthday dinner and my daddy. And we're going to a couple shows, which we don't usually do. Not really going to play much poker, just a couple of day tournaments at Caesars, and visit that friend of mine who beat non-Hodgkin's lymphoma for the second time. So, not great that he had to do it twice in his life, once around 20 and now around 50. So hopefully he gets 30 more years. If you have any questions, put them in the chat rooms. I will be checking in the morning for a couple of minutes. But for the next 4 days, I'm going to be pretty scarce. And then next week, we'll come out firing again. All right. Take care.